Hello, everybody, and welcome back. Today, my guest is Sabrina Jacobs. Sabrina is a fixed income investment specialist at Insight Investment. Welcome, Sabrina.
Thank you very much. Good to be here.
Sabrina, today we want to discuss recent development in the Chinese fixed income market. So, in China, there have been recently been several defaults, especially by state-owned companies. So are we currently seeing a change in the Chinese government strategy?
It's a good question, really. All in all, we think that the support from the government for these state-owned companies, or SOEs, as we call them, is very unlikely to disappear completely. The National Party Congress that actually started today, so 5th of March, is very likely to reinforce the importance of those SOEs in the economic ambition of China. So really, it's still about growth, it's about fiscal policy, and also it's increasingly about the self-reliance in technology and innovation, in particular after all the friction we have seen on the trade front with the US as well in the last years. So we do think that we will continue to get comments from policymakers to support SOEs as the backbone of the economy. And that will also bring with it support for the sector. So China wants to reach self-sufficiency in advanced technology, independence in supply chains, and so on. So really, SOEs will continue to play a very leading role in this, all in all. There may not be a blank support for the sector anymore, so it's probably going to be more differentiated. So central SOEs being the priority, really. Some of the local SOEs may actually suffer a little bit, that are maybe smaller, more fragmented, deteriorating fundamentals, higher leverage, and so on. So there could be some, less support, and some may not survive. But all in all, the sector overall should be fairly solid, really.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So will investors have to get used to the fact that there are fewer implicit government guarantees on the Chinese bond markets, and that default rates will rise in the near future?
Yeah, again, I think we have to really differentiate a bit more here in the future. So looking at sectors, for instance, industrial companies probably remain a bit of a weaker link, in particular energy, IT, and materials. So this is really one of the sectors that will continue to gain some support. When we look at the real estate sector, it's more resilient for sure. This is also where we, for instance, see some more opportunities. There have been some casualties as well, but those defaults were really more idiosyncratic, not so much to issues at the sector level, really. And as regulators have increasingly allowed SOEs and government affiliated entities to default in the last 2 years or so, there could be some potential for mismanaged zombie companies, potentially, considering to default or restructure even, instead of kicking the can further down the road. But once again, I would point really at this really low default rate overall that I just mentioned. And we do really think that selective government support will continue to be there.
So there's kind of discussion going on that inflation could come back, and especially in the US. So could inflation lead to interest rate hikes in the US? And what consequences would that have for the Chinese bond market?
Yeah, sure. And that's obviously very topical. I mean, we have seen the increase in interest rates pretty much across the board in the last few weeks. Inflation concerns and also inflation rates are going up. So I think one thing here is to note that we will see an increase in inflation rates this year, pretty much across the board. But a lot of that is really also due to base effects. So clearly there were some very significant one-off effects at play last year. When we think about Germany, for instance, we had a VAT cut. There were energy prices had collapsed at the beginning of the COVID crisis. So all these factors are coming out of the annual rates, and that's where we see an increase. The question really is how sustained and long-lasting this increase will be, or whether also we may overshoot expectations here. At this juncture, it is still difficult to see where we're, in economies that are very far from potential output still. And if you think that a lot of government support programs have been at play, at some point these will fade out. So we may actually see higher unemployment rates consistently persist. So those are all, the issues that may actually see inflation not spiral out of control in the longer term. The Fed, I think, has really told us they will allow a bit of an overshoot of inflation above the 2%. They also kind of promised us not to increase rates before 2023, which is something that we at Insight also agree with. But of course, we have seen the longer end in particular of the curve move. And when we look at EM and in particular China on a credit side now, on the corporate side, spreads have actually been okay so far. That actually holds for credit overall so far in this move. And what is very interesting in China, when we look at credit spreads, the differentiation between the investment grade side and the high yield side. So we think that because in the investment grade, you have much lower yield levels, and B, you have a longer duration, i.e. your sensitivity to these rates moves are larger. So we like to be more on the high yield end of the spectrum at the moment, in particular also in the external credit side, so the dollar denominated debt, because there you have less duration and you have higher overall yield levels. So those moves in treasuries are not typically playing out as much.
So during the Corona crisis, an incredible amount of capital flooded into the Chinese bond market. So how did that additional liquidity affect the Chinese bond market?
It's a very interesting topic, and I'd like to focus here a bit more on maybe the rates market now, the government side of the Chinese market. A lot has been driven not just by Corona, but even before that by index inclusion. So we have seen a few index providers, like for instance, Barclays, JP Morgan, the WGBI index, they have moved to include China in their local bonds benchmarks. So that has seen and is continuing to see money flowing in from passive investments. So we estimate that all in all about $300 billion worth of inflows are due to these moves. So it brings obviously some interesting dynamics. So the Chinese local government bond markets had been very dominated by local investors previously. So now you have an increasing share of foreign ownership. It has doubled or so over the last few years. In 2018, it was about 5% foreign owners. Now it is over 10% foreign owners. And it has various benefits for the Chinese government. It gives them access to a lot of liquid pools of capital and funding as well. It creates a curve, for instance. It creates a more liquid and stable government bond curve, of which other assets can be priced as well. So it is really in line with this ongoing opening of the capital market, the financial markets in China as well. And overall, we do think it is quite a positive development for the local bond markets because the demand from foreigners is increasing. The flip side, obviously, is almost 90% is still locally owned, and a lot of the commercial banks are owners, which is not necessarily a negative thing because these are often just buy and hold investors. So they buy and then they hold these bonds to maturity. So it's a very stable investor base that lends obviously also support and and comfort for foreign investors. There is some attempts to open up more to retail investors as well. But obviously, ultimately as well, it will depend on what the local investors are doing as well. And as China opens up and allows more outflows, there is obviously also some risk that, local investors could buy more foreign bonds instead and go out of Chinese bonds to some degree. So that is something that we haven't really seen so much yet, but that is very worth watching closely. We do find the bonds very attractive. So from an investment point of view, when you look at the yield levels, they are far higher than, what you see in other markets. Rates are much higher. So you have 10-year China is about 3.2% in yields compared to, as we know, minus 30 basis points or so, what you get in Germany at the moment in the 10 years. So that is attractive. Clearly, there is some currency risk involved. If you hedge that all for the currency risk, then that yield disadvantage pretty much goes away. But we're quite confident also that the currency is fairly stable. So it is worth picking up some of this yield advantage as well. And the correlation, because the foreign ownership is so low, still, the correlation is low to other markets. So it is also a good diversifier for your portfolio. Because when you think about a global bond portfolio, bonds in Germany and treasuries and gilts in the UK, they're all fairly correlated. But when you add Chinese local bonds, the correlation is pretty low. It's about 15-20%. So it's a good diversifier for these global portfolios as well.
So you already named one of the keywords for the next question. So given the current trade surplus in China and its re-rising and the strength of Chinese economy in international comparison, how high is the appreciation risk for the yuan?
Yeah, so it's interesting because there used to be for a very long time very strong appreciation pressure on the currency, and obviously the PBOC in China, the central bank, has managed the currency quite tightly for a long time. The current account surplus used to be much larger, and it was still 2% or above 2% most of the 2010 to 2020 period, but it has actually declined as well. Because China has also, the dynamics have changed, the focus on the exports is less, so it's the plan is to focus more domestically as well. Imports have gone up, so for that reason, the external surplus is a bit lower these days, so that takes off a bit of that appreciation pressure, but it is still there. And when you look at the currency and a chart of the currency, you can see that since last summer in particular, it has been on a nice appreciation trend against the dollar, but also against the euro pretty much. So we have actually been positioned long in the Chinese yuan for a while already, and we still like the currency. We don't forecast massive appreciation potential, but the key is that we see it fairly stable. And I think that's also pretty much in line what the policymakers in China really want. And then even in the currency, you can pick up the yield advantage. So if you just look at the forwards, for instance, versus the dollar, you can pick up about 2.5% per annum of a yield advantage in the currency. So for us, it's more of a stable carry trade, why we really like to be long the yuan.
This was Sabrina Jacobs from Inside Investment. Thank you very much, Sabrina, for being with us today.
Thank you, Thomas. It was my pleasure.